we're going to focus on the cost of operations and try to get a handle on understanding what it takes to run our business. And specifically, we're going to focus on the cost associated with manufacturing a product. Um, on the left side of your screen, I have a comparison of product cost versus period cost. There's two ways that a company might classify their cost. One way is whether or not the cost is related to manufacturing or something else. Another way has to do with cost behaviors, and we'll talk about that in just a minute. So, for just a minute, focus on everything to the left of this black line here. So, when a company incurs a cost, some of those costs are related to the production of the product. We call these manufacturing costs, and that includes the cost of the materials, the cost of the labor, and then the rest of the manufacturing operations. We call that manufacturing overhead. So, for example, when Apple manufactures an iPhone, they've got a lot of materials in this, the semiconductors and the circuitry and the batteries and all that stuff that you can see. They have those material costs. They also have the labor costs. Somebody is putting all that together. That's the direct labor. And then they also have the cost of just the factory where everything is done and keeping it lit up and heated and cooled and so forth. We would call all of that the manufacturing overhead. So the cost of the iPhone consists of the the cumulative effect of the material, labor, and overhead that goes into this iPhone. So the rest of the cost in the business that are not related to the production of the iPhone, we call those period cost. So the difference is this: all of these product costs, material, labor, and overhead, are going to go into the cost of inventory. They're going to, like this iPhone, the dollars associated with this iPhone will be included on the balance sheet in our inventory accounts until we sell this iPhone. And then the cost of the iPhone will go to the income statement as cost of goods sold. On the other hand, all of the other costs not associated with manufacturing are called period cost. Those would be things like the sales department or the general and administrative department. Those are simply expenses for the period. These other costs go into the cost of the product. So let me show you a ledger down here at the bottom just to illustrate this. On the left-hand side, I'm showing you some of the inventory costs that we deal with. Let's say we buy inventory of materials like semiconductors, thinking about iPhone, semiconductors and batteries and all that type of thing. So the cost of materials would be in the material inventory account. When we start building the product, those materials would be sent to the factory and they're accumulated in another inventory account called work in progress. And that's where we add the material, the labor, when the individuals are actually working on the product. And we would also assign a certain amount of the factory overhead to that product as well. When you finish the product, the cost of that finished inventory is taken out of work in progress, WIP, and taken to finished goods. And then as long as that product is sitting on the shelf, then the cost of that product is in the finished goods inventory. When the product goes out the door with a customer, then the cost of that item is taken out of finished goods and over to cost of goods sold. Cost of goods sold is on the income statement. Other expenses on the income statement would be things incurred during the period. That's what we call them period expenses. They're not related to the cost of production, but there are, other costs that the company had to incur: rent, utilities, not on the factory, but on, say, the administrative offices and that type of thing. So, one way a company classifies their cost is whether or not it's related to the manufacturing of the product, so we call that product cost, or it's not, and we call those period cost. Now, when you're thinking about the cost of the product, the cost of production, and you have material, labor, and overhead. Material and labor are sometimes called the prime cost or the direct cost because you can trace those costs directly to the unit, to the product. We know it, we can identify how much material is in this iPhone. And we also know that somebody worked, let's say, 30 minutes on this iPhone, and we were paying them $20 an hour. So we know how much labor it took to put into this iPhone. However, we also need to assign a little bit of overhead to it, and that overhead is, we call that an indirect cost. It's not, you can't really trace it directly to the iPhone. So we have to have some kind of a way to assign all of these overhead costs to the product. So let me show you a little example of that down here. So the question is, in blue, is how should manufacturing overhead costs be assigned to the product? Well, what we're going to do is pick some reasonable way to allocate the cost. As an example, suppose we have total overhead cost of $300,000. So what we could do is assign all of that overhead to our production based on how many labor hours were involved. So for example, let's say we had two products, A and B, and we spent 2,000 labor hours on product A and 8,000 on product B. So we might give 20% of the overhead to product A and the other 80% to product B. On the other hand, we could assign our production cost based on machine hours. So maybe the product A is more automated. It took less labor but more machine hours. So let's say we had 6,000 machine hours on product A, 3,000 on product B. So 2/3 of the machine hours were used for product A. So maybe it would get 2/3 of the overhead cost, the other third going to product B. So we need to pick a way to allocate cost to our product. And as you can tell, that allocation base that we pick would have a significant effect on how the costs are assigned. Like in this example, if we were using labor hours to allocate the cost, then out of the 600,000 overhead, 60,000 would go to product A, 240 to product B because it had 80% of the labor hours. On the other hand, if we were using machine hours, and most of the machine hours were with product A, then product A would get assigned a lot more of the overhead, in this case 2/3 or 200,000, leaving 1/3 or 100,000 to go to product B. So again, depending on the allocation base that you select, it can really impact how you're assigning those costs. So you want to pick an allocation base that does a good job of representing which product line is using more or less of your overhead. So when you get down to the nitty-gritty of that, we pick an overhead rate. Like I told you, we had $300,000 of overhead. Well, we might divide that total overhead if you were dividing it by the direct labor dollars, you'd get an overhead rate of 136%. So that means that if you assigned, say, $10 of labor to a product, you'd assign $13.60 of overhead. Or if you were assigning overhead based on direct labor hours, if let's say we had 10,000 direct labor hours, well, that'd be $30 of overhead per labor hour. So if we were working half an hour on this iPhone, it would get $15, half of that overhead rate. And a third example, if we were allocating our overhead based on machine hours, and we had 9,000 total machine hours, well, that's $33.33 of overhead per machine hour. And so, again, so if we were using, 2 hours, let's say, 2 machine hours on a unit, then it would get $66.66 of overhead assigned to it. So again, each unit that we're making in the accounting records, each unit we're making is going to be getting materials cost, labor cost, and then some allocation of overhead. And all of that goes together to make the cost of that product. As long as the product is sitting on the shelf, then the cost of that product would stay in either WIP or finally finished goods until that product goes out the door, and then the cost of the product is taken to cost of goods sold. Okay? So, one way of dealing with cost is to consider whether or not the cost is related to the production cost of the product, or related some other type of cost. We would call that a period expense. That division there, product versus period, that would be what a public financial statements would be based on. That would be considered in accordance with generally accepted accounting principles. Another way that to classify cost, which could be of more benefit from a manager's perspective, is to understand how those costs behave. Costs tend to be either fixed or variable, or sometimes a mixture of the two. A fixed cost, here's a picture of a fixed cost. A cost that stays the same regardless of how much volume you have. And when I say volume, I mean like how much you sell, how much you produce and sell. So fixed costs stay the same. Things like salaries, rent, advertising. Let me see if I can enlarge this just a little bit. So, again, sorry about that. Okay, so these costs tend to stay the same. They're fixed. Other costs look more like this. We call them variable cost. The more the volume is, the more the cost goes up. So that'd be things like, the more you produce, the more materials you incur. The more you produce, the more labor you have to incur, unless you're just keeping your workforce consistent regardless of how much you are producing, then that would be a fixed cost. Sales commissions would typically be a variable expense. Variable expenses go up and down with the cost of production. So in total, when you add your fixed cost and your variable cost together, you're going to have a picture that looks like this. Again, let me see if I can enlarge this a little bit. So you've got your fixed cost On top of your fixed cost, you'll have your variable cost. So the variable cost is actually the additional cost, and that top arrow is indicating where your total costs are. So in a later week, we're going to look at how we can use these our understanding of cost behaviors to determine what our profit's going to be, and kind of get a better feel for break even and that type of thing. But this week we're focused simply on the cost itself, understanding the nature of your operations and how the costs behave is a fixed thing, is a important issue. So if you look at this comparison again, your income statement, sorry about this. Your income statement might be based in accordance with GAAP, where you have sales minus the cost of goods sold. That has to do with that product cost, and then minus all of your other expenses. Or if you're focused on the cost behaviors, you've got your sales minus your variable costs, the costs that go up and down with volume. And that difference is called contribution margin. And so you have total sales minus total variable cost is total contribution margin. Then subtract your fixed cost, and you come out with your net income or net profit. So, two different ways to classify cost.